You're listening to the Financial Source podcast on YouTube.
Welcome back to the Financial Source podcast. While the U.S. government shutdown is officially over, the market is finding itself in a strange spot.
A very strange spot.
Yeah.
That relief rally we were all expecting in the dollar.
It's completely muted.
In fact, the dollar is actively losing steam. It's being driven by a new, and I think more complex, anxiety.
Which is this potential data vacuum, right? The uncertainty around critical October economic figures.
Exactly. We're talking about CPI, the jobs numbers.
Yeah.
The big ones.
And this is making it incredible. The DXY, it was slipping toward weekly lows. And that's the central tension right now, isn't it? The funding bill passed, the government is open.
But the dollar is not being bolstered at all.
So what's going on there?
What's fascinating here is that the market had priced in the risk of the shutdown, but the subsequent risk, this data drought,
That wasn't fully anticipated.
not at all. The White House has signaled that critical October data, specifically the Consumer Price Index and that monthly jobs report, they might not be published on schedule.
Or maybe not at all for a while, and that just creates a massive analytical fog for traders.
Especially when the Federal Reserve is so explicitly data dependent.
Right, they're relying on inflation and employment figures that might not exist. So what are traders doing instead? How is the market trying to see through this fog?
That's the key question. Traders are having to pivot to secondary, often less reliable, inputs.
You mean things like the private sector surveys?
Exactly. They're leaning heavily on ADP employment data, regional Federal Reserve manufacturing reports. But here's the kicker for you.
They're not always accurate.
They're fragmented and often conflict with the official Bureau of Labor Statistics data. So any forecast you build on this substitute data carried a much higher error rate.
And that increases the risk premium across the board.
It does, which helps explain the immediate reaction we saw in foreign exchange.
The euro-dollar pair breaking cleanly above 1.1670.
Right, and that movement wasn't really about some fresh catalyst out of the Eurozone.
No, it was just pure, unadulterated dollar weakness.
Driven by this structural lack of data clarity here in the U.S.
And we saw divergence in other pairs too, didn't we? What about cable?
Good example. Take cable, so that's the British pound against the dollar. It initially dipped after some soft GDP data from the UK.
Okay.
But then, as the dollar universally weakened later in the session, cable just recovered all of those losses pretty quickly.
So the dollar's weakness was like a rising tide lifting all boats, even the leaky ones.
A perfect analogy.
But wait, if the market is worried about global uncertainty, shouldn't we see a rush into traditional safe havens? I'm thinking about the Japanese yen.
That's a great question.
It seems to be easing off resistance near 155.00, just staying in its band. Why isn't the yen screaming higher with gold?
Because the yen is caught between two really powerful opposing forces.
Mm-hmm.
On one side, you have that safe haven demand we just mentioned. But on the other, you have intense pressure from the Bank of Japan. They are signaling very clearly their readiness to intervene if things get disorderly.
So that warning from the Bank of Japan puts a ceiling on the yen's appreciation.
It does. It makes traders hesitant to use it as their primary uncertainty hedge right now.
Yeah.
Unlike gold, which doesn't have a central bank trying to manage its price.
So this data vacuum has shifted the whole FX focus onto regional fundamentals and central bank policy clashes.
It has. And the real outperformer actually was the Aussie dollar.
It got a strong boost from that surprisingly solid labor data out of Australia.
A classic example of a data-dependent market, seizing on the one piece of reliable information it can find.
And its neighbor, the New Zealand dollar, is lagging behind.
It is, partly due to pressure from the Aussie-New Zealand cross-pair, but fundamentally, Australia's employment strength gave the Aussie dollar a clear, data-driven narrative that the Kiwi just doesn't have right now.
The market rewards clarity, especially now.
Always.
Okay, so since the Federal Reserve is essentially flying blind on domestic metrics, let's pivot to the other macro input that's suddenly dominating global trade friction.
This is a crucial pivot for you to understand. When core domestic data is missing, anything that impacts trade balances, the flow of goods and money.
It gains a magnified importance.
Exactly. On the surface, we've got news that Washington might reduce tariffs on some popular groceries.
Which sounds broadly positive, a nod to easing the cost of living squeeze.
Right, but globally, the friction is still there. The European Union, for example, is accelerating a crackdown on cheap Chinese parcels coming into the bloc.
And why does a shipment of consumer goods matter to the euro's valuation?
It matters intensely because of the trade deficit mechanics. Brussels argues that these extremely cheap goods hurt domestic European manufacturers,
And widen the trade deficit.
which weakens the euro's fundamental position. So by cracking down, the EU is engaging in targeted protectionism to support its own industries.
So trade policy is now being seen as an inflation and competitiveness tool.
Precisely. And we're seeing this dynamic everywhere. It's not just a US-Europe issue. India just imposed anti-dumping duties on Vietnamese steel.
It just proves that while the headlines focus on the U.S. fiscal situation, this underlying trend toward trade protectionism is still very much alive.
And directly impacting FX volatility worldwide. This whole backdrop of friction and data uncertainty is proving highly supportive for safe haven assets.
We mentioned the yen's constraint, but gold. Gold is climbing significantly.
It is. Spot gold is trading near $42.35 per ounce, approaching its session highs.
It's that classic combination, isn't it? A weaker dollar and rising macro uncertainty.
The perfect recipe for gold.
It's a classic risk-off signal. But what about energy markets? They often react violently to these kinds of shifts.
Crude benchmarks are relatively steady, actually, despite everything. West Texas Intermediate is anchored around the $58 handle, and Brent is around 62.
Why is that? I would have expected more volatility.
Well, earlier this week, we saw a pretty sharp slide after the Organization of the Petroleum Exporting Countries. OPEC revised its 2025 supply outlook upward.
Ah, so that reminder that an oversupply risk is building is keeping the lid on prices.
It is. The market seems to be focusing on that long-term oversupply risk from OPEC instead of the immediate geopolitical flare-ups in the Middle East.
That's interesting. So the perception is containment.
That's the word. The market view seems to be that while tensions are high, they are contained and not currently disrupting major shipping lanes or production hubs.
And that prevents a major spike in oil prices, for now.
But the risks are still there, providing that constant, low-level backdrop.
Right. We've seen fresh artillery strikes in Gaza and Khan Yunis, and reports about Israel seeking a new security agreement with the U.S.
And further north, the rhetoric between Russia and Ukraine remains pretty consistent. A classic stalemate.
While the group of 7 ministers reaffirmed their plan to tighten economic pressure on Moscow.
All of this feeds into the risk premium embedded in certain commodities and regional trade flows.
Okay, so this global risk structure, amplified by the U.S. data vacuum, brings us back to the Asia-Pacific region. You mentioned the Bank of Japan?
The BOJ, yes. They've reaffirmed their readiness to intervene if long-term rates move in a disorderly way.
That signaling is so crucial because they're basically putting the market on notice, aren't they? Saying, we are watching our back door while the U.S. is distracted.
Exactly. And the absence of clear U.S. rate guidance only highlights Japan's precarious position even further.
Then you have the political friction, with China criticizing comments from the Japanese prime minister.
It just adds another layer to that global risk structure, forcing investors to price in more regional instability.
It's interesting, though. Base metals seem to be doing well.
They've extended their gains, yeah. Benefiting from the resolution of the shutdown, 3-month London Metal Exchange, copper, peaked near 10,980 per ton.
So, relief for industrial activity, but this profound uncertainty for the Federal Reserve.
Well, copper is seen as a bellwether for global industrial demand. Its rise indicates that the market views the U.S. government being open as a net positive for future economic activity.
Essentially dismissing the data vacuum as a temporary problem.
A temporary non-structural problem.
Right.
But that optimism is tempered by the cautious trading we're seeing in U.S. equity futures.
Right. They're trading cautiously. The shutdown risk is gone. But this data absence risk, the realization that the Fed is flying blind, that's still being absorbed.
It's a truly unusual scenario. The government is open, but the data-dependent market has to operate without the data it needs.
That lack of clarity has reversed some of the early enthusiasm. We saw bonds, the Japanese yen, and gold all catching a bid.
It confirms that until Washington clarifies what's happening with the October data, markets are operating in a profound fog.
Relying on trade friction and geopolitical headlines, the macro driver of U.S. interest rates has been temporarily sidelined.
Which leaves micro drivers and external factors to dictate price action.
So the question for you, the listener, is this. If the market remains forced to rely on fragmented private surveys and geopolitical headlines for the next 4 weeks, what underlying economic weakness is that substitute data guaranteed to miss?
That wraps up our analysis of this unique market scenario. where volatility remains elevated due to the lack of clarity from Washington regarding economic data releases.
We truly appreciate you tuning in today. Join us again next time on the Financial Source podcast for more essential market knowledge.